Hello everyone, welcome back to another episode of the Capital Lens. In the earlier part, we laid out the broad framework of how to look at the Singapore property market, not just asking whether prices will go up or down, but looking at property through three lenses: building capital, preserving capital, and deploying capital. Because when we buy property, the goal is not just to hope that prices increase. The real question is, can this property help me build capital over time? Can it help me preserve capital and manage downside risk? And am I deploying capital into the right asset at the right time with the right strategy? So in this episode, we are going into the real drivers behind the market. To understand where opportunities may come from, we need to look beyond individual projects and study the moving parts behind the scenes. First, population growth, because over time, more people, more households, and changing housing needs creates underlying demand. Second, housing supply, because demand alone is not enough. We also need to know whether enough homes are coming in, where they are located, when they are ready, and when they match what buyers actually want. And third, government policy and developer behaviour, because BTO launches, government land sales, land bids and developer inventory all affect the pricing and future exit demand. So if you stay till the end, you will have a clearer sense of where we are today, why future new launch prices may continue setting new benchmarks, and why some demand may eventually rotate back into the resale market. Because the goal is not to predict the market perfectly, the goal is to understand the market clearly enough so that you can make your next property decision. You are not just reacting to headlines, you are deploying your capital with more clarity. When looking at government policies, the first thing we need to understand is the intent behind them. Broadly speaking, the goal is to maintain a stable and sustainable property market where prices move in line with economic fundamentals rather than speculation. One key benchmark is affordability. This includes indicators such as median household income, which helps measure whether the housing prices remain manageable for the average household. At the same time, the government also manages supply to meet genuine housing demand. This is done through tools such as the government land sales for private homes and BTO launches for public housing. By adjusting supply when needed, they aim to keep the market balanced and reduce the risk of excessive shortages or overheating. And in terms of the government policies, there are about 10 key factors we can examine. The first is population growth, which drives long-term housing demand. Between 2021 and 2025, we saw that Singapore's population increased from 5.45 million to 6.11 million. At first glance, that points to a growing demand base for housing. But when we look deeper, the story becomes a little bit more nuanced. The number of permanent residents has largely remained the same across the years. This group is important because some PR households may eventually transition into ownership demand. Given HDB rules requiring PR households to meet the 3-year mark before being eligible for public housing, some may choose to enter the private residential market instead. What has changed more significantly is actually the rise in non-residents from 1.47 million to 1.91 million. Why does this matter? Because non-residents are more likely to rent rather than purchase homes here, especially after the additional buyer stamp duty for foreigners had increased from 30% to 60% in April 2023. We will cover the additional buyer stamp duty in the upcoming series. Let's look at the citizens. The Singapore citizenship actually increased from 3.5 million to 3.66 million. On paper, that's an increase of 160,000 people. And if we examine the average household size, we see that it has been hovering around 3% per household. So what is the impact? Since the citizen population increased by around 160,000 people, we divide that by an average household size of 3, that points to demand of more than 53,000 homes over time, which is roughly about more than 10,000 homes per year. And that is just a broad estimate because the population growth alone, it does not include Singaporeans coming of age and entering the market as first-time buyers, families restructuring housing arrangements, citizens who may eventually buy a second property. Since the tightening of the immigration framework in the late 2009s, we have maintained our number roughly at similar rates. Between 2015 to 2019, the average number of citizens granted each year was around 20,500, while permanent residency approvals were about 31,700 annually. Moving on to 2020 to 2024, we see that citizenships granted was 21,300 per year, while average PR households increased to about 33,000 annually. With the total fertility rate at record lows and an aging population growth is likely to rely on immigration. And that is why the government has recently signaled plans to grant around 25,000 to 30,000 citizenship over the next 5 years, compared with the average of around 21,300 new citizens a year between 2020 and 2024. That represents roughly a 20% increase in intake. For permanent residents, the indicated pace is also higher, around 40,000 a year, up from about 33,000 a year previously. What this means is, over time, these inflows can translate into additional housing demands. So directionally, it suggests that demand could be stronger than what we saw between 2020 and 2024. Of course, it is not a one-to-one relationship. Not every new citizen or PR buys immediately, and housing demand depends on many other factors such as affordability, life stage, and market conditions. But at a broad level, higher inflows can support a larger future demand base for housing. The second point is on the supply side, mainly through our BTO launches and the government land sales program, which influences how much housing stock enters the market. And that is why, on average, we have seen BTO supply maintained at around 20,000 units a year from 2021 onwards, which is about double the amount of homes based on the 3 household size for new citizens. This reflects the government's effort to keep pace with underlying housing demand from a growing population, new household formation, and the backlog that emerged in earlier years, especially during the COVID period where there was pent-up demand. And we see that for 2026 as well, and the projected figures that we saw, 55,000 BTO units from 2025 to 2027. Of course, there is also some changes in the HDB policy when it comes to build-to-order supply. There is an introduction of the new HDB classification framework in October 2024. Under this framework, new flats are now categorized into standard, plus, and prime. And this is largely based on location and surrounding amenities. Why does this matter? Because not all BTO supply is equal. A flat launched in a prime or highly connected location may come with stronger demand, but also tighter resale conditions, longer minimum occupation period, and subsidy recovery requirements. On the other hand, standard flats may offer fewer restrictions, but be in less central locations. So if we take a plus flat as an example, there is an important timing effect to understand. If someone successfully applies for a plus flat in 2025 and we assume about 3 years of construction, the flat may only be completed around 2028, and from there, the 10-year minimum occupation period. The unit may only enter the open resale market around 2038. This means supply available today is very different from the supply available for the resale in the future. If housing demand remains firm and future BTO supply is reduced over time, there could be periods where available resale stock does not fully meet demand, especially in attractive locations where buyers want immediate move-in options rather than waiting years for a BTO. Of course, this is not guaranteed. It depends on how demand evolves, future policy moves, affordability, and how much supply is launched in the years ahead. However, it also means that choosing a BTO flat today can be a much longer commitment than people realize. If we factor in the construction period plus the minimum occupation period, your holding timeline could easily be around 13 to 15 years, depending on the project. This becomes a time commitment and a future flexibility decision, because life can change significantly over that period. Your family size may change, your income may improve, your priorities may shift. you may eventually want to move on to the next home sooner than expected. And for plus or prime flats, there are added considerations such as subsidy recovery upon resale. On top of that, future resale buyers also need to meet the prevailing eligibility conditions and the income ceiling, which can narrow the buyer pool compared to a less restricted resale demand. In terms of the private condominium market, one of the main ways for new supply is the introduction of the Government Land Sales Program managed by URA. This is where the government releases land parcels for developers to bid on, which can eventually become future private residential projects. The GLS program is typically divided into two categories. One is the confirmed list. These are sites that will be launched for tender according to a planned schedule. This gives developers visibility on the upcoming supply and allows the market to plan ahead. The second is the reserve list. These are sites that are only triggered for sale when there is sufficient developer interest. Usually this happens when a developer commits to a minimum acceptable bid price for the site. Once that threshold is met, the site can then be released for tender. This makes the reserve list more demand responsive as sites are activated when market appetite is stronger. We see that the first half of 2026 land supply has also been maintained at a relatively high rate, indicating a continued pipeline of future housing supply. This suggests that the current pace of land release remains supportive of upcoming residential development rather than being scaled back in a significant way. It is also a part of a broader trend that we have been seeing since 2024, where land supply has generally remained elevated as part of efforts to maintain a healthy pipeline of future homes given the demand that we have seen in the market. I would say this is actually a balancing act. Of course, one point to note is that a larger share of sites has actually been placed under the reserve list in the first half of 2026. This gives developers the option to trigger these sites if they see sufficient demand or stronger market conditions. In that sense, there is flexibility in the market as well. The other thing that we should note when we're understanding the government land sale site is actually there is typically an internal valuation. If bids do not meet the acceptable level, the site may not be rewarded. For example, Marina Gardens Crescent was one of the sites that was not awarded. So in other words, not every tender automatically results in a sale. Why is this relevant? Because it adds another layer of discipline to the market. It helps prevent sites from being released at prices that may not reflect broader market conditions, while also avoiding unnecessary distortion from weak bidding environment. At the same time, it means that land supply is managed with some form of flexibility rather than being very mechanical. In practice, this contributes to a more measured market cycle where supply can be adjusted and sudden imbalances may be reduced. And if we look back a few years, we see that between 2022 to 2024, the new launch condominium sales were actually running at around 6,000 to 7,000 units annually. This was a period where the market was actually moderated by cooling measures together with a higher interest rates, which actually naturally softened the buying momentum. And from a developer's lens, bidding behaviour during such period is usually more cautious, especially when there's still unsold inventory in the market. Then in September 2024, the US Federal Reserve began its rate cutting cycle, which improved market sentiment and eased some affordability pressure. At the same time, the government had already increased land supply in 2024 to support the future pipeline of homes. This is relevant because when a land parcel is awarded, the eventual project is typically launched only about a year later, and for executive condominiums, it will be after the 15 months mark. At this current point of recordings, we can see that many of the recent launches have performed relatively well. Apart from Nara Residences that launched earlier this year, projects such as Newport Residences sold at about 57% on launch day. River Modern, Pinery Residences, and Revel EC actually all crossed 90% take-up rate on launch day. We also expect Tengah Garden Residences to do as well. From a developer's perspective, this changes behavior. When unsold inventory starts to reduce, attention naturally shifts towards replenishing the future pipeline. Developers still carry ongoing operating costs, teams, and business commitments. So once existing stock is sold down, the next question actually becomes for them, where will the next project be? And that is why developers have become more active in upcoming land tenders when they have fewer remaining units to sell. And this is the reason why we have seen stronger land bid outcomes for well-located sites. For example, the Plum Newton site actually achieved 1,820 per square foot per plot ratio, and this is notable for a core central region. We also see the Dover site crossing 1,556 per square foot per plot ratio. And amongst them, for the Newton plot, there were actually 8 bids. 8 developers were interested in that plot. On the other hand, if we go back a little further, 2013 was actually a key turning point for our property market. That was when the Total Debt Servicing Ratio (TDSR) framework was introduced, requiring borrowers' total monthly debt obligations to remain within a set proportion of their gross monthly income. This had a meaningful impact on financing capacity and buyer affordability. Following this introduction, private residential prices fell over 12% across the next 15 quarters. At the same time, land supply had earlier been moderated to allow the market also to absorb existing unsold inventory. This meant there were fewer newer projects coming through the pipeline during that period. Over time, as the market worked through this unsold stock and inventories tightened, developers eventually needed to replenish their land banks, and that was one of the factors that contributed to the en bloc wave we saw from around mid-2016 to 2019. So it is always a balancing act between what is available from the government land sales, and if not, developers will need to look at the en bloc opportunities. So when clients ask me if we are entering another en bloc wave, the short answer is it depends largely on the supply. If the government releases enough, developers have a direct pipeline of land to bid for. So the urgency for en bloc deals is actually lower. But when GLS supply tightens and developer needs future projects to replace sold inventory, collective sales then becomes a more attractive option. So the most recent one we have is the Loyang Valley sale. At around $959 per square foot per plot ratio, it came in much lower than some of the more recent land bids we have seen in the outside core region. From a developer's perspective, if the eventual selling price is around 2,000 to 2,001 per square foot, that is a workable margin that they can actually work with. This suggests that actually opportunities still exist in the market so long as the price is right. However, the average unit size is estimated at around 1,076 square foot each. At that price point though, if we are looking at 2,000 to 2,001 per square foot, that would be around 2 over million. At that price point, initial take-up may be more measured because buyers tend to be more sensitive to the total quantum in that area. So while the land price may look attractive, eventual sales performance will depend on how the developer does the layout, how they position the price, and whether the quantum actually eventually meets the buyer's demand. So where are we today? Right now, the market is broadly split into 2 phases: the pre-harmonization stage and the post-harmonization stage. Following the changes announced in 2023, what we often observe between market phases is a kind of a semi-reset in pricing. New launches enter at a fresh benchmark, buyers recalibrate, and developers adjust bids based on the new environment. But over time, one pattern tends to stand out. The low of the next phase tends to be higher than the low of the previous phase. And the same can apply to the highs as well. At the current stage, many of the earlier post-harmonization projects where land bids were more conservative at the start are gradually being absorbed by the market. As the supply gets taken up, we are beginning to see the next level of land bids move higher, which may suggest that the window created by those earlier conservative bids is slowly closing. So where are we today may be less about the start of a new phase and more about the market moving into the next level of pricing. And given the strong take-up rates of many of the new launches over the past year or so, prices have gradually moved into a new range. As new launch prices reach higher levels, we may start to see some demand rotate back into the resale market. Because for many buyers, there comes a point where the gap between the new launch pricing and resale alternatives is too hard to ignore. If you have made it this far into the video, you'll realize that property is never just about the price alone. It is shaped by policies, supply and demand, timing, and how each cycle creates new opportunities. This is exactly what the Capital Lens is about, helping you understand the market with more clarity so that you can make better decisions with confidence. In the next episode, we will continue to decode the Singapore property market and unpack more factors that can shape your next property move. If you found this useful, do support the channel by liking, sharing, and subscribing. It really helps more people to discover the content. If you like clarity on whether your current home is helping or hurting your next move, feel free to reach out to us for a one-to-one consultation. I will see you in the next episode of The Capital Lens. Bye!